Well, if you guys are wondering how I went from IT to mortgages, numbers. Numbers on the IT side, numbers on the mortgage side, finance numbers, IT numbers. I think I was able to kind of just transition over, and just being self-employed and all was something that I wanted to do, so that's why I chose this, in case you guys are wondering. I think I just want to start off with just a little bit of a comparison between residential and commercial, right? And on a day-to-day, we talk a lot about residential, but commercial is something that is a little bit more niche, and people that are involved in it really kind of focus on that area. And so when we look at residential, it's obviously a property that someone is going to be living in, right? It's going to be owner-occupied, or it can be an investment, but somebody is really taking over as their home. And we define that as something that is 4 units or less can be a residential property, and you can go get a residential mortgage. Loan to value, so the amount of down payment that you have to put on a residential property can be as minimum as 5%, so your loan to value is 95. Usually that's when you hear those mortgages are CMHC insured mortgages. You have those on the commercial side as well, but the program is very limited in terms of how it offers and how it is offered in the commercial space. A lot easier to do the residential mortgages. There are a lot of the houses in the GTA are cookie cutter, right? So moving from one house to another, there's some differences, but a lot of it is similar. On the commercial space, it's exactly the opposite, right? You have land versus retail and a whole other area of commercial that you have to be cognizant of, and the mortgage for that property will be different as well. And usually, obviously residentially, most of them are personally owned, even though some of them may be for investment purposes as well. So multi-unit residential properties, warehouse malls, and I think you guys have a good idea of what commercial properties will be. And the minimum loan to value can actually vary, right? If you're gonna get something that is more than 5 units, it's gonna be more on the residential side. You can get a CMHC mortgage that is going to be 80%, 85% loan to value, but as you go into your different types, like warehouses, malls, and land, the loan to values will start to differ there as well. And it can take several months. It can take up to several months to arrange mortgages on the commercial space. Either it can be quicker, but a lot of the times you're dealing with appraisals and inspections and all of that. That can take a few time, and you don't really want to rush the process either. Okay, so some of the challenges we see on the commercial space is, difficulty in obtaining a loan. As we talked about earlier, different types of property, who's buying it, is it one person, is it an entity, if it's multiple people with businesses, all that stuff has to be kind of looked into to see what the financial situation is of a certain buyer before they can go ahead and get a loan. Higher interest rates as well is something we experience on the commercial space. And then detailed risk assessment, and that's what really does end up taking the majority of the time. And then the credit worthiness of a business. So if a business is buying this property, how well established are they? What kind of business are they in? Are they in a real estate business, or are they coming and branching off and it is a new venture for them? And all that stuff will play a role into how quickly we can get them a mortgage and what kind of a mortgage product that they get. And then the last one over here that I have is regulation and compliance. Obviously, every business, every type of a residential or every type of a commercial property will have to abide by different regulation and compliance, and that can also come into play, and there can be different types of tests and inspections that need to be done accordingly as well. All right, so who do we see lending on the commercial side? Obviously, you have your big banks, right? They are a big player in every sort of financial transaction that takes place in Canada, so they're definitely going to be involved. But these are also the folks that are the most restrictive, right? They have a very stringent set of rules that they have to follow, and they may like a certain, and so it's all about how you kind of present that project out to them as well, right? And who is buying it, they're gonna take a look into all of those things before they feel comfortable lending. And then you have non-bank lenders, and not necessarily private, but they can be financial institutions, it can be credit unions and such as well. And they might have certain niches or products that they may be more comfortable with doing, and it might be beneficial for somebody to go in that direction. And you may come up with a little bit of higher interest rates, but it will be a a niche for them, so you'll be able to get a lending that you need to. Then you have private lenders, which is increasingly popular over the last year and a half or even 2 years. Is basically they fill in the need for the space where the big banks and the non-bank lenders are not willing to lend. It's obviously they're not going to be just willing to lend just for everything just because they're private. Like as you see on the residential side, they're very equity based. So if you have a good loan to value, you will get a private lender to lend you money on residential. But in the commercial side, it is not as easy, but easier than the banks and the non-lenders. And then you can use a lot of collateral, you can give personal guarantees, so a lot more that you can kind of play around with to be able to get a mortgage from the private lender side. And then the last one that I have here is vendor take-back mortgage. And I don't want to get too much into like how to get a mortgage, right? Because that's more so on the buyer side, right? So I want to focus more so on the vendor take-back mortgage, which is basically the seller is going to be the one providing that financing and allow the buyer to be able to take a mortgage from the seller, more or less. Right, so a vendor take-back mortgage, we also refer to that sometimes as the seller financing or vendor financing. And it is basically an agreement between the seller and the buyer. Whereas instead of the buyer going to a bank to obtain a loan, they're basically going to get a loan from the seller. So it can, for one example, it can be like somebody was to sell some land and the buyer was not able to get financing. The seller can say, hey, look, how much money do you have and what's the situation? So if they have, let's say 50% down to put, they can get a 50% mortgage from the seller itself. And then the terms of that can be negotiable with the seller. A lot of times they actually don't even involve a mortgage broker within it. Usually just a lawyer is what you need. But we're seeing that as vendor take-back mortgages are becoming more popular, mortgage brokers are getting more involved because either they know they can't get financing from the bank, so they get involved just to kind of help out with that process there as well. And the loan terms and all can be very flexible as well. It is up to the seller pretty much in what terms and stuff and conditions that they're comfortable with. A lot of times you may not need to do certain inspections and appraisals because the seller feels comfortable with how much money that they are getting from the buyer and the loan to value that they are comfortable with. And then typically it can be done in 2 ways as well. So the buyer will make regular payments like a typical mortgage. It pays the principal and the interest until the loan is fully paid off, or they can have a temporary solution which can be for a few years or even months where it can just be a lump sum money that is loaned out. You only pay the interest on the loan, and then when the term for that is up, you pay the loan back in full. Okay, and so obviously the best thing about this is it's all about flexibility, right? When you're not able to get a mortgage and you do have a motivated seller who really needs to get this property pushed out for whatever that reason may be, and they're willing to give you the financing on that property. More or less, even when the seller is, excuse me, is giving out a mortgage, they do want to take some precautions, right? So you're not just like, hey, I need to sell this property, so I'm just going to give it to anybody for X number of dollars and just loan that amount. You still have to be risk savvy. You still have to understand what is the risk that you are taking, because ultimately, if the seller, if the buyer is not able to make the payments at a later date, that can be some financial hardship on the seller side. So we always recommend that you do seek legal and professional support during this process. If you're more experienced, sure, you can take some things on your own, but you do want to get the help of professionals and do things the right way. You do want to focus on the debt servicing and debt service coverage ratio where applicable, maybe not so much on the land area side, but if you are talking about office buildings or restaurants and industrial spaces, you do want to make sure that you are doing the basic checks of the debt servicing. You want to make sure you look at the people who you're actually giving this mortgage out to. Are they creditworthy? Are there any personal financial issues? If they're buying it through a company, how much leverage does that company have? And where else are they involved, and how much credit do they actually owe? Because if they owe a lot of money for other areas to the banks or to other people, and you're giving them a high loan to value loan on your property, that can ultimately come back to bite you as well.
How about farm agriculture? There is a residential housing side.
So for that it will,
Well, agriculture, not.
yeah, so if it's zoned as agriculture, you know, from a bank standpoint, they don't consider that as a residential, right? So that home that's there, it's gonna be less, they're not gonna consider that at its value, they're gonna be like, what's the price of the actual land there, right? So it won't be a residential mortgage if it is on an agriculture side. So you would have to go through, so it would be more or less like a land. And then, like I said, the loan to values on lands in a stable market when everything is good, those are the loan to values, 55. But I was talking to a gentleman today and he's saying, you know, in some areas you can even find them to be a little bit lower as well. Right, and that'll ultimately come down to be what you're comfortable with.
It's not considered residential at all, half or some percentage.
If it's zoned as agriculture, that's what the zoning of it they're gonna look at, right? So a lot of the like A-side lenders will likely say no to that from a residential mortgage standpoint. Right, and you also want to look at the current business, the current market, how things are going within the market. Obviously, when the market is supporting, a lot of people are willing to take more risks, and you have less chances of getting caught off guard. But in a market like this where it's volatile, you definitely want to take that into consideration as well. And then your down payment, which ultimately ends up being the loan to value, and I have, you know, in a decent market, what you want to look at for the different types of properties, and then also collateral, right? Like a lot of times where you're willing to make one move, can you mortgage something else with it, right? Can we get a personal guarantee? Can we get some other properties or other businesses that are doing very well to be involved within the mortgage as well? And all of that can be done just from the vendor seller perspective as well. Now I wanted to keep it short and concise. Any questions?
You mentioned for the vendor take back that the mortgage agent would be involved in that process. How does that happen out of curiosity?
Like a mortgage agent, legally they don't have to be
As a
involved.
favor.
Oh, as a favor, like
Yeah, so a lot of times what happens is like you're working with a mortgage agent to get financing from space, but then the mortgage agent a lot of times will be like, hey, no, that cannot be done. But you know, they do give retainer fees and all of that, right? So you can be like, hey, as part of that, I can help you organize and make sure and do some due diligence for you on your behalf to make sure that the agreements that you're going into are okay, do a little bit of the risk assessment and sort of support them through the process. But you don't have to go with a mortgage agent if you want to do it.
I'm just curious, because then it's like the B2B is supposed to be done as a second and the big bank's going to be the first, and how does that work?
No,
I'm just curious.
B2B can be a second if they really need it to be, right? But if it's a second, it's like I'm not really selling the property, I'm getting a second mortgage, right? Like if you're selling the property, you necessarily there wouldn't really be a second.
I'm just curious how because you mentioned the mortgage agent would be involved, so
yeah, but they don't have to be involved. So it's like if two real estate agents meet and they find out that is the best option for them to kind of go through, they don't need to involve. So I just wanted to kind of just be clear there. That you don't need it necessarily need. But as we're seeing more vendor take-back mortgages take place, you are seeing mortgage agents also be a little bit more involved than before within the process.
okay.
Any other question? We're good. Thank you so much.
Thank you.